Hello, everyone. Hello, everyone. Thank you for joining us. So I'm Stuart MacArthur, the Head of Sales and Marketing at Cooee Group, and your host for today's Cooee Group's 2024 Investment Outlook webinar. Whether you're a seasoned investor or just dropping your toes into the financial waters, welcome aboard. Thanks for joining us, and there's more people joining as we go on. We are expecting quite a full webinar, should I say. So I'm also expecting a lot of questions coming through. Now, navigating the investment landscape can be as tricky as trying to find your way through a maze in the dark, but fear not, because we've got you covered with this webinar, jam-packed with insights and expert guidance to help make sense of it all. So get ready to set sail for a successful 2024. Now, I'm thrilled to have Andrew Grinsell with us today, a true expert in the field with over 18 years of experience in financial services. Andrew has successfully navigated clients through a diverse range of market conditions. His track record speaks volumes. Having advised on portfolios worth over $500 million, Andrew's wealth of expertise includes roles at prestigious institutions such as Citibank, Colonial First State, and Cooee Wealth Partners. So please join me in extending a warm welcome to Andrew. Welcome, Andrew.
Thanks, Stuart, and thanks for everyone for joining today.
Yeah, thank you, everybody. Now, I do need to go through a few disclaimers before we do get started. The information presented in this webinar is for general information purposes only and should not be considered as personalised financial advice. So please consider, or it does not consider, your specific objective financial situations or needs. So before making any investment decisions, you should be consulting with your professional advisor and who will take into account your specific circumstances. And so we recommend you obtain financial advice specific to your situation before making any investment decisions. Please note that past performance is not indicative of future results, and any investment obviously comes with risks and potential loss of principal. Investment involves inherent risks, including capital loss, volatility, liquidity risk, inflation risk, credit risk, and interest rate risk, currency risk, regulatory risk, and economic risk. I think that about covers as much of the disclaimers as we possibly can. Now, what I wanted to do before we dive in, for those of you who are new to Cooee, I'd like to give you a quick overview of the group and the collective expertise that brings. Now, imagine navigating your financial journey with clarity, confidence, and a trusted partner by your side. That's the Cooee Group difference. We're not just another financial service provider. We're a collective of passionate experts dedicated to one thing, and that's helping you achieve your financial goals, whatever they may be. So think of us as your financial co-pilot. We specialize in wealth planning, obviously where we build and manage your wealth with personalized strategies. Mortgages, that's all about securing either your dream home or investment property with tailored solutions. Accounting is another division we have here, another part of the group, and really that's about gaining clarity on your financial picture with expert accounting guidance. And property strategies, maximize your returns on your investment properties with proven advice and proven strategies. So what really sets us apart, you might ask? We collaborate seamlessly. Our different specialities work together, which really means that we offer a holistic solution. We listen to you. We tailor our approach to your unique needs and goals, and we bring experience. Our qualified specialists are here to guide you every step of the way. And a big thing is about transparency. Open communication is key to everything that we do, so you always know what's happening. And that collectively with the Cooee Group, if you want to find out more after this particular webinar, if you're new to Cooee, I'll give you a bit of a guidance on how you can find out more about the whole group and the collective. So look, we are filling up and we do want to keep this webinar relatively quick or without going too much into the overtime part of it. So what I'll get on with is the agenda. So let's have a quick look at that. First, we'll take a retrospective look at 2023. We'll revisit the key economic themes and market events that shaped the past year and discuss their impact on various asset classes. This will help us understand the current landscape and obviously our outlook for the future. Next, we'll turn our focus to 2024, the economic outlook. We'll share the insights on the anticipated economic trends, potential risks, and opportunities on the horizon. This will equip you with a broader understanding of the macroeconomic environment in which obviously investment decisions are based. With a solid foundation of economic context, we'll then delve into the 2024 outlook for each major asset class. We'll dissect the major asset classes, highlighting potential opportunities, risks, key factors to consider, and obviously key factors to consider in your investment strategy. Following the asset class breakdown, we'll discuss how to position portfolios for 2024. We'll present actionable strategies and practical tips for allocating those investments. Finally, we'll dedicate some time to your questions at the end. So don't hesitate to ask anything that's on your mind, whether it's seeking to clarify anything on specific asset classes or general market conditions. Whatever questions come to mind, please send those through. You'll be able to click on the Q&A tab and put those through at the end. So get ready to gain valuable perspectives, exploring promising opportunities, and ask those burning questions that you may have. We're here to navigate 2024 together. So without any further ado, Andrew, I'll hand that over to you to get started.
Excellent. Thanks, Stuart. Let's start by talking about what we saw in 2023. The factors that influenced economies and markets are still playing out and will impact investing in 2024. Around about this time last year, 85% of economists were expecting that the US and global economy would suffer a recession. It was expected that central banks would continue raising interest rates, eventually triggering a widely forecast recession. Then an interest rate easing cycle would commence. From an investment perspective, it was expected that stock markets would fall and bond yields would remain high. Instead, the opposite mostly happened. Inflation fell faster than expected, as seen in this chart. A recession was avoided, stock markets rose and bond yields fell. We turn our attention to the investment returns across the major asset classes. They are all positive throughout 2023. In this chart, in the green, we've got the one-year return for all of the major asset classes, and then in blue, we've got the December quarter. So starting at the top, we've got Australian shares as measured by the ASX 300, so the 300 largest companies on the Australian stock market. Pretty good year. We ended up with a 12.3% total return, but as you can see, the blue bar is where most of that return came from in the final quarter. So we started out with the year not looking so great, but then came home pretty strong in the December quarter. If we then move on to international markets, we've got the Morgan Stanley Capital Indices All Country World Index. Basically, this is the measure of international markets excluding Australia. It ended up with an even stronger 20% return, both in Aussie dollar terms or local currency terms. Within that, there's obviously a few different regions that make up that all-country world index. So we can see the S&P 500 a little bit further down the list there, which tracks the largest 500 companies in the United States. It provided a 25% return, and then within that, we've got a further breakdown there, which is the MSCI USA Value and the MSCI USA Growth stocks. So what that does is it tracks different types of companies within the United States, where the value index is heavily skewed towards financials, healthcare, and industrials. You see that it didn't quite perform as well as the growth stocks, which is heavily skewed towards that IT sector, which is obviously grabbing a lot of headlines, as well as consumer discretionary stocks. Moving a little bit further down the list, we can also see decent returns were produced from fixed income investments, cash, and a few other investment grade credit items there, around sort of 5 to 10% in 2023. So look, overall, it was a good year. Now, 2023 also introduced us to this new term of the Magnificent Seven. So, we used to have BRICS was the term, then we had FANG stocks, and now we're talking about the Magnificent Seven, which includes companies like Facebook or Meta, Amazon, Apple, Google, Microsoft, Tesla. These 7 companies were absolute powerhouses in 2023. They did bounce back from a fairly rough 2022 where they were down around about 48% from peak to trough. Now, the performance of these 7 stocks significantly influenced the overall return that was produced from US share markets in 2023. It actually accounted for most of the gains. So when we have a look at this chart on the right-hand side here, we can see Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia, they were up 71% against the S&P 500 up 19%. If we actually took those 7 companies out of the S&P 500, so the remaining 493 companies were only up 6%. So what that does is it shows us just how concentrated the recovery in US markets was last year and that it wasn't widespread. So obviously Nvidia topping the list, being up 239%, which is just phenomenal. Now, if we look ahead economically, obviously speculation continues around the direction of interest rates, inflation, and economic growth. Over the long term, earnings drive investment returns, but in the short term, investors are looking for economic and other factors that could impact these future earnings. So one of the key questions for 2024 is whether everyone got the timing wrong on the arrival of that recession that was expected last year and the interest rate cuts that were expected. So at this point, what we'll do is we'll focus on the United States as it does remain the world's largest economy. In the chart on the left, we can see that both Morningstar and the consensus economic forecasts are for economic growth to fall to between 1.2% and 1.4% for 2024, before bouncing back a little bit as we get into 2025, 2026, 2027. And that's when interest rates are expected to have come into effect and therefore boosted economic activity. The chart on the right provides us with the projected inflation, which both Morningstar and the consensus forecasts are for inflation to fall back to and even possibly below the US Fed's target of 2% per annum by 2025. Now, if we just look outside of the United States for a moment and talk about some of the other major regions, Europe's been hit pretty hard by a downturn in global manufacturing and also demand weakness from China. That's particularly impacting Germany. The UK economy did have a larger inflation shock than other developed economies. They're still battling the fallout from Brexit. So both Europe and the UK are expected to underperform the United States economically in 2024. Japan's also another area that has been a bit of a hot topic with economic growth looking quite promising. There's accommodative or quite low interest rates and accommodative monetary policy there, and their above trend economic growth is forecast to continue. One of the things we do have to be careful of with forecasts, however, is they're often wrong, as we saw with the 2023 forecasts, all widely expecting that recession that never arose. And that's because there's the potential for surprises both to the upside and the downside. So when we're investing, we need to make sure that our portfolios are constructed to handle these sort of surprises. Some downside scenarios exist, such as where a recession occurs, whilst it's not the base case right now. If a recession were to occur, it could be off the back of households exhausting all of the cash that was saved up during the COVID lockdowns and the low interest rate environment that followed. As these households spend their savings, expenses will have to be cut back, which can harm economic growth and trigger a recession. There's also the positive for upside economic surprises. So, for example, if economic growth remains strong and inflation falls by less than expected, this might mean that interest rates could start falling later and at a slower pace than what the market is currently pricing in. Now, that would actually be a bad outcome for both share and bond or fixed income investors, because higher interest rates tend to lead to lower valuations on both shares and bonds. So we do need to be mindful of the fact that whilst you can have a base case scenario, it doesn't always play out. It can play out where you have positive surprises or negative surprises, and therefore we need to invest accordingly. Now, if we just have a quick look at those interest rate expectations, we can see the chart on screen is illustrating what the markets are currently expecting or pricing in for the central bank policy rates. So markets do see central banks as having finished increasing interest rates, with interest rate cuts actually forecast for most of the major economies commencing in 2024, actually around the sort of May, June, if you have a look there on the chart. But one thing we've got to be mindful of is the central banks themselves aren't ruling out the possibility of further interest rate hikes if inflation persists, and they are considering that the current speculation surrounding rate cuts is a bit premature. It was only last week that the Reserve Bank of Australia Governor Michelle Bullock was in front of a House of Representatives Economics Committee, and she commented that the existing inflation rate of 4.1% per annum is really just too high to start contemplating rate cuts. However, she did also go on to state that if the RBA was confident that inflation was falling below or on track to fall below the 2.5% target that they have, that they would look to cut interest rates before we actually get down to the desired inflation number. So we've just got to keep this in mind, because if markets are too optimistic with the timing and the pace of interest rate cuts, it does mean that investment returns in 2024 could be negatively impacted. But for long-term investors, look, whether interest rates cuts arise or eventuate in May, June, or a bit later, it really shouldn't be too much of a concern. Look, in the short term, it's going to create a bit of volatility, but in the long run, it really shouldn't have a meaningful impact on the earnings of the underlying investments in which our clients are allocated to. All right, just a couple of other factors that we do need to consider that are at play in 2024. Obviously, the geopolitical environment is increasingly concerning. We've had the return of military conflict in Eastern Europe, and also obviously a ramp up in the Middle East, and then not to mention the abrasive relationship between the US and China. These conflicts have already impacted commodity and energy prices. There's also the economic impacts to be considered of the increased military spending that we're seeing in Europe, Asia, and the United States. It only takes a minor escalation in the conflict in the Middle East to potentially drive up energy prices, and this could have central banks hold back on those anticipated interest rate cuts. Aside from that, we've got decarbonisation as another factor that investors must be aware of due to the potential for inflationary pressure. Shifting from fossil fuels to renewables requires significant upfront investment in new infrastructure and technology, which can push energy prices higher. We've also seen the emergence of deglobalisation as Western countries are seeking to address their dependence on Chinese and other Asian manufacturing capabilities. Initially, globalisation was driven by cheap labour, lower environmental and safety standards, and any reversal of this can lead to higher prices, more inflation, less chance of interest rate cuts. Without wanting to sound too negative, we do have some positive factors, however. Things like artificial intelligence is obviously gaining a lot of traction. Past technological breakthroughs such as the printing press, steam engines, electricity, computing, all these things enhance productivity, increased growth, and eased inflation pressures. AI does have that same potential. What we've got to remember is that negative news stories do tend to flood the news cycle. There are positives out there. Inflation has fallen without a recession. Interest rates are at or close to peaking. Economic growth has proved resilient. Australia's federal budget is on track for a surplus. And finally, if we do end up in a recession, it's likely to be quite mild. All right, so that's it for the economic side of things. Let's chat about investing. So one thing that it's important to note is that investment markets are forward-looking. They price in the expectations around future economic, company, or asset performance, not just the present. So with higher borrowing rates and less money in the financial system, investments will need to compete more on fundamentals than has been required in recent years. Quality, price, value, and risk will all matter once again. As Warren Buffett famously stated, a rising tide floats all boats. Only when the tide goes out do you discover who's been swimming naked. So to dive into that a little bit further, when money was free, loss-making companies could survive on the promise of future earnings. But with higher borrowing costs and more difficulty obtaining borrowings, companies will be forced to reduce debt rather than just continuing to refinance it. Fortunately for investors, however, we do have bonds becoming substantially more attractive now that yields have increased, or interest rates have increased, resulting in higher yields on bonds. We can now add bonds to a portfolio to reduce risk, smooth investment returns, and provide quite a reliable source of passive income, something we haven't had the opportunity to do so at this level since prior to 2013. So the other thing with bonds is that if interest rates do fall, so if we get those interest rate cuts, the value of bonds tends to rise as they're inversely correlated. So if if interest rates go down, bond prices go up. If interest rates go up, bond prices go down. So there is some opportunity there if those interest rates cuts do arise. But what we've got to remember is that risks do exist. They always have. For active asset allocators like us, we see these risks as creating opportunities. For US equities, they've managed to return 7.4% per annum above inflation for the last 100 years. And that's despite having been through 2 world wars, the Cold War, global pandemic, and a wide range of other economic crises. However, getting to that 7.4% per annum return above inflation has not been a straight line. So what I want to do is have a quick look here at Morningstar's asset class game board. It's something that Morningstar produce every 6 months. What it does is it shows us the performance of the 7 major asset classes over the last 20 years. It does a good job of illustrating the winners and losers. So at the top of each column, we have the top performing asset class for the year, and then it goes down to the bottom performer. So it does a good job of illustrating who the winners are and the losers, but it does a better job of showing us how difficult it is to predict future winners. There's no consistency, it tends to go through cycles. There's a few investment lessons here. So one of those is that cash is gradually becoming more useful. It was the top performer in 2022, but that's more so because everything else fell. More importantly, though, 3.2% return on cash is the best we've seen since 2013. Another point to look at here is that the last time bond yields were at the current levels was back in 2013 and prior. So if we have a look at the yellow and orange on the game board, we can actually see the benefit that bonds provided to portfolios, especially through that difficult period as the global financial crisis unfolded from 2008 through to 2012. We can see in more recent years that international equities have had a fantastic decade, mostly due to the performance of US stocks. Australian small companies have swung wildly. So that's the light blue. Sometimes they're at the top, sometimes they're at the bottom. Australian large caps in the teal there have been quite consistent performers. In fact, if we actually look at it over the last 20 years, Australian shares have averaged a 9% per annum return, which is actually higher than international equities at 8.4%. But that's obviously no doubt largely being driven by the really strong years we see at the beginning of the game board during the commodity boom that no doubt benefit Australia. But the key takeaway for investors from the asset class game board is that top performing asset classes don't often stay at the top. It tends to move in cycles. All right, so as we just touched on earlier, obviously US shares have been quite a strong performer. However, there's been some big downturns along the way with falls of more than 20% every few years and some greater than 40% on a few occasions there. So look, for some investors with a really high risk tolerance, you might have felt comfortable riding through these ups and downs to reap those long-term rewards. Many more investors, however, just won't have been as comfortable to hang on for the ride. So what we need to do is obviously have a well-diversified portfolio to smooth out these ups and downs. A lot of people, if they were down 50% on their portfolio that just consisted of US equities, would really start doubting their strategy. So it's quite tough for somebody to actually maintain conviction and stay invested through the ups and downs that we're seeing on the screen here. So when we look at portfolio construction and also a lot of queries that we get from our clients, they're often asking us if they should be increasing their exposure to areas that have recently performed quite well. You've no doubt all heard the disclaimer that past performance is not a reliable indicator of future performance. And this chart here really illustrates why that's the case. So the blue line, in that blue line, what we have is a forecast return for the US share market that's been built by taking the average return for the previous 20 years and expecting that that average return will be what occurs into the future. In the orange, we have the actual returns that have been generated over rolling 10-year periods. Now, if past returns were a reliable indicator of future returns, the blue and the orange lines would move in tandem. As you can see, they don't. So if using this method, when we have a look at this method, we can see that when the forecast returns are high, using historical or back testing, actual returns end up being low and vice versa. To put it another way, past performance does not provide an indicator of future performance. In fact, it moves in opposite directions. High returns are usually followed by low returns, and low returns are usually followed by high returns. So using past performance as a guide is a bad idea. Is there a better way? In our view, yes, there is. So we look at the fundamental value of assets, and one of the ways that we do that is looking at what's called a PE ratio. So let's start by thinking about an imaginary company that's not so creatively named ABC. If ABC earned $1 of profit for every share that it has on issue, and those shares are trading in the market at $16 per share, this means that the market is willing to pay $16 for each dollar of earnings. So we can call this a price to earnings ratio, or a PE ratio of 16. Now, for that share price to increase, either ABC must have an increase in earnings. So if it was earning $1 per share and went to $2 per share, and the PE ratio stayed at 16, we'd go to a $32 share. Or the PE ratio must increase. So that's the price that investors are willing to pay for each dollar of earnings. On this screen, what we now have is the PE ratios of the major markets. So again, the PE ratio tells us how much you're paying for each dollar of profit that a company makes. Globally right now, investors are paying about $18.70 for every $1 of earnings. That's the blue. In green, we have the median. Things get a little bit more interesting when we zoom in. I mean, if we look at it just at a global level, sure, a little bit above the median, not too expensive, not too extreme. When we move to emerging markets, investors are paying $13.50 per dollar of earnings. Now, this is obviously a bit less than what the median is in green. So what that does is it suggests that investors are much less optimistic in emerging markets than what they are across the globe. In contrast, when we move on to the United States, investors are paying $22.20 for every dollar of earnings. Now, that's more than anywhere else. So that means that investors in the US are very confident in the US company's future earnings. When we actually spoke about the Magnificent Seven stocks earlier, those companies, their PE ratio is 51 times. So that means for every dollar they earn, investors are paying $51 for those shares. It means investors are really expecting big things from those companies. When we look at Australia, Europe, UK, and Japan, PE ratios are a bit below the average, suggesting that investors are a bit more cautious. So overall, what does it mean? It means that investors are very optimistic on the US and some specific star companies, whilst being a lot more cautious around the rest of the world, and that's reflected in share prices. We take that a little bit further. When we look at what drives investment returns, there's three key elements. It's the current income, the forecast earnings growth, and the valuations, or the PE ratio that we just talked about on the previous slides. So if we take this and take that into Australian equities, what we end up with is a dividend yield currently at 5.8% per annum when we include franking credits. Expected earnings growth adds 1.9% to share prices, and the fact that the PE ratio in Australia is a little bit below the median, we add that to the valuation factor, and we're looking at an expected return, or a forecast return, of Australian equities at about 8.6% on average over a 10-year time frame. If we then go and take that over to developed market equities, so that's your international shares in developed economies, so US, UK, Europe, we're looking at a dividend yield or current earnings of 1.8%. earnings growth is no doubt stronger. So there is an expectation that earnings will grow faster internationally than in Australia. But what we don't get is the valuation effect. That's because the stocks are already trading at a high PE ratio. We can carry this on through other markets and effectively end up with emerging markets at 8.3%, real estate investment trusts at 7.5%, conservative fixed income, so like government bonds at 4.5%, high yield debt, which is higher risk fixed income at 6.3%, hedge funds at 3%, and cash at 3%. All right. So how reliable is that method of forecasting? So if we show how this approach has worked in the United States, sure, it's not perfect, but it's a whole lot better than using historical returns to forecast future returns. Most importantly, it identifies periods of high returns and periods of very low returns. You'll see that the orange and the blue lines are much more closely aligned here than what we saw under that alternate method of using past returns to predict future returns. In Australia, very similar scenario as well. Forecast returns under this method, very close to the actual returns. Again, much closer than what we saw when we use historical returns to try and predict the future. Now, just want to talk about the tipping point tables briefly. A lot of data, a lot of information on the screen, but really what it comes down to is if we look at each of the major asset classes, in red on the left-hand side, we have the arrow pointing to where those markets are currently trading. As those markets go up in value and become more expensive, the forecast future return comes down. Quite simply, the more you pay for something, the less further upside there is expected to be. So if we go across those tables there, we can see Australian equities are trading around about the middle of what's considered to be fair value. Developed market equities are right at the upper end of being fully priced, almost falling into being overpriced. Emerging markets are also sitting at fair value. And then we've got Australian real estate investment trusts also sitting at fair value, but at the upper end of it, getting quite close to fully priced. We can then dive in a little bit deeper and have a look at what's going on within developed market equities and break it down across the US, the rest of the world, excluding the US, and then emerging markets. So whilst developed market equities do look quite expensive and estimated to provide about a 5% per annum average return over the next 10 years, based on current prices, a lot of that overpricing sits in the United States. So the S&P 500 is right at the upper bound of being overpriced, whereas excluding the US, we're much more comfortable. We're back down to fair value, and again, the same in emerging markets. Now, using this framework, we believe that investors taking a dynamic asset allocation approach can improve returns. So with dynamic asset allocation, it's all about moving ahead of events, sometimes up to 2 to 3 years in advance of any events occurring. It's not dependent on correctly timing the market either. It's a long-term strategy. The thing is, it's not blind to excessive valuations. It's all about investing in reasonably priced assets and, most importantly, avoiding investment in overpriced assets. Now, if we just quickly step through each of the asset classes. So in Australia, we've got dividend yield of 5.8% per annum when we include those franking credits. That's a great starting point for investors. Australia looks relatively attractive given fair valuations at the moment and really low expectations of earnings in the year ahead. So another way to look at this is there's not a lot of expectation for Australia, so there's plenty of room for surprises. We've also got the benefits of the commodity linkage, especially commodities that are required for new technologies and the energy transition. And then with increasingly volatile geopolitical events, countries like Australia are standing to benefit as investors and customers from the developed world look to bring their supply chains back to more friendly nations. One of the key arguments that we often see against investing in Australia is the over-reliance on banks and resources companies. But look, the Australian Big Four banks are 4 of the 7 best capitalised banks in the world. So it's not a bad place to be getting your financial services exposure. And on the resources side, we've got businesses like BHP and Rio and Fortescue, which are world-class operators. When we look at international markets, as I said, US is quite expensive on most metrics. They do have some good expectations around future earnings, and we could see a bull market in the US that does extend to those 493 stocks that didn't get all of the upside last year, so outside of the Magnificent Seven. Outside of the US, earnings are increasing in Europe and the United Kingdom, and valuations are also low, so that does provide some good potential upside. Whilst the US is expensive, we still do recommend an allocation to it in client portfolios, albeit at lower levels than what we've traditionally held, because opportunities do exist beyond the Magnificent Seven. Overall, in international markets, we do prefer quality stocks or quality companies. These are companies that have got more resilient earning streams, stronger balance sheets. They're better positioned to withstand the pressures of what is still relatively tight monetary policy, rising debt, and a deterioration in consumer spending. These sort of companies tend to fall less in a downturn and recover faster. So by having this quality style in our exposures, it does allow us to still participate in upside growth, but providing a bit more downside protection. We're also mindful that the US dollar could weaken, so therefore we've hedged out our currency exposures. Emerging markets, obviously one of the biggest challenges is China's economy. China's a major trading partner also for other emerging markets, and a slowdown in China can also result in weaker demand for exports from other emerging markets. Rising interest rates also have posed a challenge as capital tends to leave emerging markets and find its way back into the now higher returns available from US dollar denominated assets. So investors also just need to be mindful of the ongoing geopolitical uncertainties, but these challenges are largely priced in. We've seen that in the PE ratios on the earlier slides. These markets are trading below their historical averages, so it does provide potential for opportunity. And we're also seeing above average growth in some markets like India, where we've got some exposure for our clients. India is expected to be one of the fastest growing major economies in 2024. So look, overall, we think adding emerging markets into a portfolio, whilst emerging markets are higher risk in isolation, they do help reduce overall portfolio risk due to the added diversification we get from investing across different geographies, different economies, and getting different return drivers. On fixed income, a lot of investors felt quite burnt by what happened in 2022 and 2023, but we're now looking at a point where real and nominal yields are at their highest levels in 15 years. Vanguard are expecting Australian bonds to return between 4.3 and 5.3% per annum on average for the next 10 years. That's much better than the 1.3 to 2.3% per annum they were forecasting before the latest interest rate cycle. We can also step up the risk spectrum and move into things like private credit, investment grade, high yield, and add to that yield, obviously with higher risk. So one of the key things we've got to think about with fixed income is it is a very, very diverse asset class, with the relative safety of government bonds at one end of the spectrum right through to distressed debt at the other end of the spectrum. And the more risk you take, the more return you should get. Moving on to property and infrastructure. Look, higher interest rates and tougher borrowing conditions and a slowing economy have seen quite a divergence in the performance we've seen across real assets. And when I talk about real assets, property, infrastructure, what we tend to see is environments where inflation's above average and economic growth is falling. Infrastructure's historically provided quite solid returns compared to international shares and bonds. And in our portfolios, we are carrying an overweight allocation to infrastructure. So we've just got to be mindful, though, that all the property sectors are sensitive to interest rates, and different structural changes and trends will impact these different sectors in different ways. Demographics really do support housing and healthcare. Deglobalisation is also great for supply chain and logistics businesses, whereas office space is probably most challenged as we've seen the change in working habits following COVID and work from home being more prevalent these days. Historically, it's the office space where a lot of the industry funds have had quite significant exposure. Worked well for them in the past, but it's going to be interesting to see what that does moving forward. Just quickly, I want to touch on alternative assets. So in our portfolios, we're running quite a substantial exposure to gold. The economic forces that determine the price of gold are quite different to those that determine the price of other assets. So we often turn to gold during periods of uncertainty. When we've got deflation, gold's shown its ability to maintain its value. When we've got inflation and purchasing powers being eroded, we typically see gold also as a store of wealth. So just quickly on that chart there, we can actually see during major downturns in say, Australian equities, international equities, and emerging market equities, in the pinky purple colour there, we've got the price of gold, and it's tend to move sort of in the opposite direction. So it provides a nice portfolio stabiliser. All right, so just wrapping that up with how we are currently positioned, you see with our portfolios, we run conservative, moderate, balanced growth and high growth. So as you step through these, each one of them takes more risk than the one before it, and therefore should be targeting higher rate of return. So on the left-hand side, we see cash, and we gradually bring our weighting down as we sort of take more risk across the portfolios, except for growth. There's just an anomaly there. Defensive alternatives, so that's your like gold. So we have quite a bigger weighting in the defensive or the more conservative portfolios, and we bring that down as we target more growth. Similarly for fixed income, that narrows off as we tend to take more risk. And then the high yield debt, so that's the higher risk end of the fixed income market. You see that look, we do taper that off as we go and bring more into the higher risk portfolios. But then what takes its place is more of a weighting towards Australian shares. You can see obviously 38% weighting to Aussie shares in the high growth model versus only 10 in the conservative model. Similar story there for international markets in the developed sense, emerging, and then also property and infrastructure, except for the balanced model, which holds just a bit more in property and infrastructure because it tends to be lower risk than equities. But it's not quite something that we can put that much into the conservative and moderate model portfolios because it would throw the risk weightings out. So key takeaways I hope everyone takes from today's discussion is don't chase past returns. We've seen that that's a bad idea. Long-term returns are more predictable than short-term returns. Really hard to predict what's going to happen in the short term. A lot of that's just noise, but over the long term, it's earnings that drive outcomes. Expect the unexpected. It's what you don't know in portfolios that will trigger upside or downside risk. If we knew it, it would already be priced in to what you're paying. When prices fall, forecast future returns go up. Share markets are offering reasonable returns. Interest rates are much more attractive now than we've seen since 2013. And sometimes the best opportunities can be difficult to grasp, like those in emerging markets right now, where the news story and the news flow is quite negative, especially around China, but the opportunity set's quite strong. So with that, I'm going to hand over to Stuart for questions and answers.
Thanks for that, Andrew, and obviously for that in-depth look at the 2024 outlook. I hope everyone got something out of that, and I'm sure there's going to be some questions coming. Now, if you do have some questions, please send them through the Q&A tab. Now, you'll find that question and answers tab at the top of your screen. Now, whilst you are doing that, so just at the top of your screen, probably under more for most of you, there should be 3 little buttons. You can click on that and you'll come to the Q&A tab. Click on that and you'll be able to send your questions through. Now, we did have a couple of questions come through a little bit earlier on, and I'm going to read through those whilst we await any further questions. So one was from Joff, and Andrew, he's asked this: what has been the optimal asset class distribution over the last few years, with what level of return, and what is the forecast best asset class distribution?
Yeah, so look, with that one, the answer is going to vary from person to person. And look, I say this with the benefit of hindsight. You would have just put everything into international shares 5 years ago. If you just had to go and pick one asset class, buy it, put your certificates in the drawer and not look at them for 5 years. But whilst a portfolio that you've put together that in hindsight consisted solely of the top performing asset class is obviously going to come out on top. But investors will have had to have endured that ride. So, you know, there was in 2022, just recently, there was a 27.5% drop in US equities. Now, a lot of investors just aren't going to be able to stomach that sort of volatility. Australian shares only dropped 1.77% in that same year. So, yeah, US equities come out on top, and with the benefit of hindsight, and if you had the conviction to you know, strap in and go through the ride, that's come out well. But really, we need to be putting portfolios together that can cater to a range of different outcomes. And what happens is, as soon as we add another asset class to a portfolio, if it's not the top performer, it will bring down the total return from the portfolio, but it can smooth out the returns on the portfolio. The other thing is, as far as trying to forecast the best asset allocation, if we had a crystal ball and knew exactly what the best performer was going to be for the next 5 years, you'd just go all in on that. But the thing is, we don't know. So that's why we need to diversify across a range of asset classes relative to each individual investor's risk tolerance, and also accepting the fact that, you know, different assets will perform differently at different times, and we just don't know exactly which one's going to be the best performer every time. And if we did, the price on those assets would go up and eliminate the potential for that outperformance anyway.
Thanks, Andrew. I hope that kind of covers that for you, Joff. Of course, if you have any further questions, please feel free to reach out to your advisor. Now, I do have one from Simon. Do you think I'm getting value from investing in Australian shares? The ASX 200 returned 6.6% per annum over 10 years, compared to the S&P 500 returning 12.39% over the last 10 years.
Yeah, look, there's no doubt that international shares performed well for investors, much better than Australian shares in the last few years. The concern now, though, and we saw it with the current valuations, is that there's not much room for further gains unless those earnings substantially improve. Now, there's already quite a bit of expectation around earnings growth. So what you would need to see for those international shares to continue to perform well is for those already high expectations around earnings growth to be further exceeded. Now, given how expensive those assets already are, it's hard to actually get a further rate of return out of that, or see more expansion. So we think there's quite a bit of value in Australia at the moment. The PE ratios are lower, the yields are lower. There's not a lot of expectation out of Australia. So what we've got to think about there is, when PE ratios are low, it only takes a little bit of positive surprise for upside in valuations. Whereas when PE ratios are really high, all it takes is a little bit of a downturn or a miss in terms of expectations for prices to fall significantly. So look, based on that, you know, we're more comfortable having a higher allocation to Australia than the United States at the moment. Also, if we actually look back over long periods of time, there are trends where you'll find it'll move in cycles where the US will outperform for 5 to 10 years, and then it'll revert back to Australia. One of the key things that's often missing when you have a look at return comparisons between Australia and the United States is it often excludes the value of franking credits in Australia, which you need to add 1.3% per annum to the returns to account for that as well. So yeah, we just got to be mindful of that. So just in summary, we've got already high valuations in the States. We don't in Australia. Earnings are higher in Australia per share than what we're getting in the States. Sure, the earnings growth's not as high, but the expectations are pretty lofty in the States at the moment, especially in those Magnificent Seven. I've seen other questions come in there as well from David. It's how will individual investors benefit from Cooee's dynamic investment methodology? I.e., how often is someone's portfolio reassessed and potentially adjusted? So look, for our model portfolio investors, we run a monthly investment committee meeting. Now, that's not to say that we're going to make changes to portfolios every month. We are mindful of transaction costs. But what we will do, or what we want to do with clients, is at least rebalance quarterly to reset you to your target allocations. But those target allocations will move in line with the tipping point tables that I highlighted earlier. So, you know, as share markets rise or fall in value, that will adjust the forward expectations of the investment returns in those areas, and therefore will change the target weights in our model portfolios and then advise our clients accordingly to make those adjustments. Just having a look through some other questions there. More an observation than a question. If US equities are so highly dependent on the Magnificent Seven, isn't it inherently high risk? We don't have to invest solely in, or when we invest in the US, we can avoid the Magnificent Seven, or there's different factors we can use. So we can push our exposure away from those companies. Some of the Magnificent Seven we don't mind, like Apple, Amazon, they're all right. We've got more of an issue when you've got companies like Tesla, where the earnings just aren't there. I think they're at a PE ratio of about 80. So what we can do with something like a quality factor fund, it'll screen out those companies that just don't have the earnings to support their valuation. So we can manipulate the exposure to the US to account for that risk that sits in the Magnificent Seven as well. I can see a question from Pauline there. How do we get more information about bonds? One of the things we're going to do after this seminar is, or this webinar, is we'll send out a survey asking our clients about what they'd like to see in future webinars. And look, I'm more than happy to run a dedicated session on bonds and fixed income, because I think it's something that has been off the radar for a lot of investors in recent years, but probably something that we want to bring to everyone's attention. So well, let me take that one on board and we'll have a look at it afterwards. There's another one there as well. Have you looked at crypto as an investment? I think this comes up at every investment seminar or webinar. Look, we have. The concern with it is that we want to value things on fundamentals, and crypto provides no fundamental value. Most of the investing in crypto is quite speculative. It's not actually being used for a means of transaction, which makes it very hard to value. Certainly, look, some people have done exceptionally well out of it. You find that when prices are quite high, we get a lot more inquiry about it, and then when it falls down, it tends to disappear. It's not something we are looking to bring into the model portfolios at the moment, mainly because we're long-term investors and we can't value it fundamentally. And yes, this presentation will be available afterwards. We'll be emailing it all out to the attendees. Thank you.
Yeah, thanks, Andrew. I've got one last question. So if you do have any more questions, please send them through now, because the last question I have here is, how do you find out more about Cooee Group business? And I don't know whether this is actually a wealth, one of the wealth partners clients or not. It could be one of the newer people that we've brought on board, or looking at Cooee as a prospective partner. Look, it's very simple. Just log into cooeewealth.com.au and book an obligation-free consultation, and we'll be able to tell you more about the business. If you are an existing client, then consult with your wealth partner, and they'll be able to tell you more about the different business groups. Now, I don't have any more. I can't see any more questions on my side. So I guess thank you very much all for joining us. I hope you've got a clearer perspective on the 2024 investment outlook. And again, thank you very much, Andrew, for taking us through that and giving us such an in-depth overview. And we look forward to you all joining our next webinar. And have a good day. Thank you and bye for now.
Cheers. Thanks, everyone. Thanks. Bye.